Hello, investors. Thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today is episode 11 of Investment for Beginners. We're going to talk about the stock, Opendoor Technologies. I'll let Manuel introduce himself.
I'm Manuel. You can find all about my work over at allinstocks.com. And today, as Michael said, he said it very, very well. We're going to be talking about Opendoor. And this follows a discussion that we had on a previous episode. You're bullish on Opendoor, and I've mentioned Zillow and how Zillow entered the iBuying business, and then it just couldn't. They realized that they couldn't be profitable, so they exited the iBuying business. First of all, Michael, for those who are watching and listening to us, could you please explain us what is the iBuying business, please?
Yeah, that's a really good introduction. Thank you. So iBuying has been making so much noise in the media lately. So iBuying is the idea that you're disrupting the purchase or the sale, in this case, the sale of your property through technology. So traditionally, if you wanted to sell a house, you'd approach a broker. Broker would come around and say, oh, I think that your price is worth a certain amount. And the broker, or two brokers or three brokers, however many people you enlist, would be determined to sell your property at any price, really, because that's how their business model works. Their business model works off volume. So they need to just sell the house. Of course, they want to maximize the incentives are to maximize the price, but it's really a business relating to volume. iBuying is kind of similar in that sense. It's a volume-based business. It's really about selling as many properties as possible and capturing some small margin. So what it does is that the companies either would have been Zillow or Opendoor Technologies. They'll buy the property. Sorry, before buying the property, the person would reach out to them and say, okay, I would be interested in selling my property to you. And in the case of Opendoor Technology, they would give you a price, and they would say, if everything is according here to what we believe the price should be, a person will come over to your property, just make some checks to see if what it is that you reported is actually what it is, and we will give you in approximately 3-4 days cash in your bank account. Now, Zillow was also trying to do this. So I'll try and explain in the first instance why I believe it didn't really work for Zillow. And then I'm going to move around to kind of talk about why I believe it could work for Opendoor Technologies. Before I go any further, I'll just explain that this is a stock that I do own. So obviously, this is not investment advice. We're just having discussion for entertainment purposes. But it is a stock that I own. So it is in my interest to see positive aspects about it because I own the stock. But I'll explain.
I'm going to take the bearish side of the argument here.
Yes. So in the case of Zillow, Zillow had a business model that was reasonably successful. The business model was to put up real estate properties on a website, and it was an advertising business model. Okay. So the advertising business model was successful.
They're like a marketplace, right?
Correct. So it's called lead generation. So essentially, a broker would pay Zillow a fee, a small amount, to list their property. And depending on how much the broker pays for them, they can get more visibility or less visibility in the website, up or down. It's a typical advertising model. It kind of gets a bit more nuanced than that, because depending on the area that you are, you could pay for certain people that are viewing in a certain area to kind of surface a bit higher. And you might not want to pay for someone that's outside of the zip code to kind of view that property. There's no point, because no one's going to view it from so far away. So it's kind of a little bit, there's some kind of flexibility in it. But for all intents and purposes, Zillow was a place that the brokers were very happy to use, that would put up their property, and they would get very nice margins from this business. So the business, it was a reasonable growth business. Memory serves me right. I think it's about 15% operating margins. So it's not gross margin, it's operating margin. So it's a cash flow generating business, successful, growing, has a moat, because if you think about it, in the US, if you want to go and see a property, you just go on Zillow. You just kind of, there's no, you don't need to figure out where shall I go, shall I look on Google, it's like no brainer. So they had a very strong business model. And there's a lot of interest in that business model from the brokerage side. Now, the iBuying was something that they kind of tried about 3 years ago to gain some traction. But their business model was to be operating margins plus or minus 2%. So it was always going to be a very, very razor thin business model. And what happens is two things. The first thing is that the broker is in that state competing with you. Do they list the property, or are you going to take the property from me? It's a conflict of interest. So that's one part of the aspect why it fell away, because they're competing with the broker, man. The broker has been paying them for years. Why would they want to be competing them? That's the first part. The second thing is you have to think about the shareholders. Zillow's shareholders have been accustomed to a while a business that's compounded at reasonable rates with very high margins of profitability. Then all of a sudden you have this new business model coming in where it's incredibly volatile, incredibly risky, and the profit margins are just going to go razor thin. So people what have I got here? What kind of business do I actually have? So A, the conflict of interest. B, the fact that it was going from a very profitable enterprise to a possibly high growth, but not as profitable business. Too many shareholders had their doubts. And while this was going up, the share price, nobody had any problems, because I've always said, as long as the share price is going up, nobody asks difficult questions. But when the share price starts to fall, people start to scratch their heads and start to think, oh, I don't know, is this really worthwhile? So that's Zillow. Opendoor Technology. Yeah, go on. Sorry, go on.
I was just adding to what you're saying, is that Zillow, it wanted to be like a market maker. So the usual way that market makers work in bonds, in the stocks, is that they're like high frequency traders. They provide liquidity to the stock or to the market, to the underlying asset. So they just buy, let's say within one day, they buy the stock and then they sell it. And they earn the spread, and usually it's a low margin, high volume business. And Zillow wanted to become the market maker. The issue with Zillow, and I stopped you before you went on to talk about Opendoor, and that's what I want to understand as well, if Opendoor works much the same way, is that they have their inventory, their houses, for sometimes a long period of time, compared to high frequency traders, right? So they keep their inventory like 6 months as they do their renovation. And then the chief executive, the CEO, mentioned when they abandoned the iBuying business that fundamentally, and I'm quoting here, we have been unable to predict future pricing of homes to a level of accuracy that makes this a safe business to be in. So their issue was that in some markets, the home prices went down. So they were losing money on the sale of those prices, because they take this long sales cycle. At long sales cycle, it's months, right?
I think it's 90 days.
90 months. Okay. So, but the thing is, it depends on what you're comparing it to, but comparing it to the traditional market maker, which has a really short cycle, they must be able to know where prices are going to be in 90 days. And what they were trying to do was trying to at least break even or have really thin margins, but they would make money in ancillary services like fees and insurance and a bunch of other services. So how is Opendoor different from Zillow in this sense, in the flipping of houses? How is it different, and how has it been able to have, as you've mentioned before, some profit margins in this?
Okay.
Although I think it still burns cash, right? I think.
No. It's gap profitable. It is gap profitable. So before I explain about this high frequency thing, let me take a back step here. So property prices don't fluctuate as much as share prices. Share prices in a week, you can be down 20, 30%. Property prices don't really fluctuate as much as that. They do fluctuate over a 90-day period, especially when things like in the COVID period where everything just went into major lockdown. But typically from the top of the crash of 2007 to 2009, it was an 18-month period of house prices falling. So it's not something that happened in 90 days. It takes a bit of time. That's the first thing. The second thing is that for the demand, let's just pivot to the other side, the demand from the people trying to sell. So you have two options as a seller of a property. You can prepare your house. You can be on the market for about a year or so trying to sell your house. You have people coming in and viewing your property several times, double checking every single angle. Then they're kind of trying to negotiate with you the price of your property. And it's a lot of stress. It's a really high stress and a lengthy process. In the case of Opendoor Technologies, they give you put your property on, take a few photos, someone comes and checks, it's done and dusted in a week, and you decide when you want to exit your property. You have approximately 2-month periods when you kind of can leave your property. So from the consumer point of view, you've just taken care of all the problems because everything is cash in your account. There's no chain. So it's like you're not in a chain of whether it's going to fall apart or whatever. So it's highly convenient. Just what you get in terms of the price relative to what you get in the neighborhood isn't such a big difference. So you'd still have to, if you're selling your property, you still have to kind of hire a broker. So they charge, Opendoor Technologies charges 5% for going through all this process, but there is not a lot of negotiation. You know the price, and if you value your time, which a lot of people do value time, it's mindless. It's just you've done it, dusted. Okay, and just one more thing before. So they claim, Opendoor Technology claims that they have the financial models that they can predict cycles to a certain extent. Now, everybody could predict cycles until they can't. If everyone remembers long-term capital, they had the two Nobel Prize winners, hedge fund with the brightest minds in the world, and they were, we can predict something to a certain sigma, and it was like, do you remember this long-term capital that crashed in 1998? The smartest people in the,
they were elaborate.
The leveraged, smartest people in the world, and they could also predict, and everybody can predict, as Nassim Taleb says, everyone can predict until they can't. Like he talks about the turkey that is waiting for like 1,000 days for basically, and then it's like everything is okay, and Thanksgiving, and then that until it isn't. So it's the same here. Everyone can predict until they can't. What Opendoor Technologies does say is that, that our models are superior and that they've got 20 consecutive quarters of positive contribution margin. So what that means is that when they sell a property, first they have to buy the property, then they sell the property, and then you have like a SG&A, which is like the cost of the management team and the technology. After everything is done and dusted, you end up with a profit margin at the bottom. This is the profit margin before tax and before interest. Just 1 minute. So they've been 20 consecutive quarters of positive contribution margin. So it's not like Zillow where they were trying to get profitable. And like we saw, I know that this last quarter was a water bath quarter. That means they kind of took a lot of just got rid of loads of costs of inventory that they were carrying, and they just needed to get rid of. Since the share price was already down, they just decided to go through the accounting and just get rid of all that. But Zillow's business model from the selling of the iBuying was negative 17% for the contribution margin for them. Now, in the case of Opendoor Technologies, you got several quarters of them being positive contribution margin. The next thing I wanted to highlight is that their interest is 0.5% more or less of revenue. So they're saying that into 22, so not next quarter only, but going to 22, they believe that their contribution margin before interest and tax could be around 4 to 6%. So just take the midpoint at 5%, and you take away the interest of 0.5, you end up with approximately 4.5% contribution margin gap after interest, but before tax. I think that's kind of a fair assessment. And one more thing. So the business is already profitable. And from Q3 going into Q4, so from this quarter, the guidance into next quarter, they're pointing for sequential growth of 39%. So they're clearly growing at a very rapid rate. They're not intent right now in maximizing their profitability. You know, at some point, they will try to do that. But at this point, it's just about getting land share and mind share of the consumer. So year over year, it's just, you know, because in last year, there was the COVID crisis and nobody wanted to really be buying and selling properties. But year over year, Q4 is pointing to approximately 1,000% year over year growth rates. Now, remember, last year, you know, it was just everything to do with selling houses. Just nobody wanted to sell houses. Everyone was stay at home, stay at home, stay home. So obviously, it's not necessarily a good way to think about it year over year, but it is quite a fair way to look at how they did in Q3 and that they're pointing into Q4 to grow approximately 40% from one quarter over the next. So by my estimate, so it's difficult to know how things are going to normalize into 2022. But by my estimates, I just checked with the analysts as well to see what analysts were saying. And by my estimates, let's say that they slow down dramatically their growth rates so that next year they grow at 70% only. It's not a lot for a company that's growing sequentially by nearly 40%. So let's say the year as a whole, they grow by 70%. That puts them on 12.6 billion in revenues. So if you take 12.6 billion in revenues, and you just for the sake of discussion, you look at their margin contribution, we explained before that at 0.5, that 5% margin contribution before interest and before taxes, you reach around about 630 million of contribution margin in 2022. Now, since the stock is priced at, I think it's around about 12 billion, you're kind of paying around 20 times forward contribution margin, which is not a lot for a business that is clearly disruptive, clearly has a lot of demand, because you can see the consumers are clearly, you know, consumers really want this product because the number of properties that they've taken on as inventory has moved by approximately 6.5K. So 6,500 properties that they moved from Q2 into Q3. So they now hold as inventory 15,000 houses. So people clearly, you know, really just want to sell via this way. And it's not something that they're trying to right now at this moment in time be profitable, but they are profitable. And that's that's the big thing that everyone has said, oh, this business model will never be profitable. So now people are saying, okay, this business model is profitable right now, but it might not be profitable in the future. And there's a lot of doubt right now. And there's a lot of doubt and not enough hope being priced in. So I don't think that, you know, I'm not a guy that invests on hope, but I think that if you're paying like 20, 25 times forward profits for businesses clearly disruptive, it's like buying something like, say, for example, for the sake of discussion, like buying Tesla at like 25 times earnings. I mean, that's a no-brainer. So if the business is growing and you don't pay too much for it, because obviously there's not a lot of, anyone look at the share price right now, there's not a lot of positive sentiment towards this company. Anyone thinks about Opendoor, they say Zillow, they say I buy, and they say, you know, I'm never touching this. And there's a lot of doubt right now. And it just reminds me of that period, like with Netflix in 2011, when everyone's saying, oh, this whole streaming world is never going to work because you're going to have to hire loads of people to ramp up your library. And there's so much doubt. And I'm not saying that Opendoor is going to be the next Tesla or the next Netflix or the next whatever, but I'm just saying the consumers clearly like it. It has a net promoter score of 70. So the consumer loves it. And if you get the consumer to love your product, more often than not, something positive may work out, provided that you hold on to the stock with an iron stomach. And this is always really easy to say. As I said at the beginning, this is always really easy to say as long as the share price is going up. As long as the share price is going up, everyone's got an iron stomach. People are happy to buy Tesla, happy to buy Bitcoin, whatever it is, as long as the share price is going up. But when things kind of start to go a bit sour, people start kind of thinking, oh, should I really be getting involved here? And that's why it's important to kind of have a bit of understanding that the business is profitable and that you're not paying silly multiples for it.
I would argue that the business isn't profitable. You may say that the contribution margin is positive, but they're still losing money on the income statement and on the cash flow statement. So that point of view that the business is profitable is, for me, it's just a point of view. And
okay, but that's because if you think about it, that's a lot to do with the stock-based compensation. So let me just get the number here. So just a second, I'll get the number up here. So they spent over the last 9 months 460 million of stock-based compensation. So if you look,
for me, that's an expense. So even if we look at the free cash flow, I count that as a cost, as an expense. So I don't buy that the stock-based compensation is a non-cash expense. For me, it's I count it as an expense, and I understand your arguments, but as you say that people are happy while the stock goes up, I would say that this business, and I understand the argument that the real estate market moves slower than the stock market and more volatile markets. But, and I would like to understand what's the difference between why Zillow hasn't been able to make money, whereas Opendoor has, if it's their
so from my understanding,
let me finish here. I don't know if it's their algorithm or what, and I want to hear your opinion. But what I'm saying is that for now they've been able this is a low gross margin and high balance sheet risk business. So as things, and I understand that real estate tends to go up in time, mostly in recent times because the interest rates have been going down, but this has a lot of balance sheet risk, and it's highly dependent on where interest rates go. And I'm not making a macro call, but it's they will hardly go down lower than where they are right now. So this is what in my opinion, is just that. It's just an opinion. I'm not saying you're wrong. I'm saying that I'm looking at the other side of the argument. This is this could be one of those like software businesses that they're spending because the opportunity is so great that they're spending, so they're not yet profitable because they're looking for a margin for market share expansion. I'm not seeing that in this business because they use a lot of cash, they use a lot of debt, and they're reliant on the market going up, the price, the housing market going up.
No, so let me just pause this for a bit. So their business model is set up to be market neutral. They're set up to be able to go through the cycle. So
how come if they buy a house today and they sell it in 3 months? How come?
So they're trying to understand within a certain margin of safety how property prices are going to go over the next 2-3 months. So they're trying. Obviously, if the property prices moves dramatically, they would be caught out. But if they were able to, in last year during the COVID crisis, the property market took a huge pause right there, and they were still able to be gap profitable from a contribution margin. So this is per house, they were still gap profitable. Now, I understand the argument that about the stock-based compensation. I mean, I don't have any comeback to that. What I will say is that this business model was founded in 2014. So they have already 7 years of built up data that they're continuously building up to navigate different property markets. it's what they were set up to do. They were not set up to do anything else, to do advertising, anything. The business from day one had one focus. How can we be profitable throughout the cycle? So it's not like just because someone is like in the case of Zillow was trying to get into this, this wasn't what Zillow was set up to do. Their operations were not set up with this one single focus. Some businesses are better than others at kind of going into and pivoting into other things. Some businesses are not that good. And I believe that in the case of this serious focus from Opendoor Technologies, that was all they wanted to do, to disrupt and facilitate, make it easier for the consumer to get fast access to their property. So how do I monetize that? So that was their kind of focus. But okay, we kind of had the two sides of the equation, the two sides of the argument. I think people might find this helpful.
Before we wrap up, I've read, and I must confess my ignorance on Opendoor, but I've read that president and CEO are both selling their stock, and a lot of it. Do you have any opinion on this?
Well, so from my calculations, I can't remember the CEO's name. He owns approximately 1 billion worth of equity. So if you founded your business and you go to do a public listing, the whole point of doing the public listing is because you want to sell a portion of your shares. So if you hold,
it might be just that you want to fund the business and you can't fund it for yourself, right? By yourself.
Nowadays, private equity is very happy to fund businesses, but at some point in time, just because you sell as portion, you still have 1 billion worth of stock. The management as a whole, owns approximately 10% of the business. So they still have a huge chunk. So yes, there are some uncertainties, absolutely, and there is as many reasons for why someone sells their shares. The Peter Lynch quote: "People will share their shares for many reasons, but there's only one reason for buying." So there is this kind of short-term noise and uncertainty right now, but I don't think that is why the business model can't be significantly a rewarding investment over the next 2 years. I think, So that's
very interesting, and we'll come back to Opendoor Technologies. I don't know, in 6 months or 1 year, and let's keep it up to date. Our conversation.
Yeah, well, maybe when we go for the quarterly results in early January, February, we'll kind of go through and say this is what we thought, and these are the new kind of bullish and bearish arguments. Cool. Thank you so much for listening. Thank you.